Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is September 14th, 2023, and today we're going to discuss the stock market. Worst fears coming true. And you might look at the market today as we go through the data. I'm going to show you about 5 or 6 different data points. But as we look at the market today, you'd think there's no fear. We're near record highs. We're climbing. We see higher highs, higher lows all throughout this calendar year. And then as we get to this area over the last 3 months, it's just consolidation after being near or reaching record highs. It doesn't look like there's much fear going on. It might not even seem like there's any concern at all or any hedging going on or anything else that would make us think that this isn't going to continue to move higher. In fact, today we're seeing a lovely little rally and we're up about 1%. But are we seeing other indications that are telling us that we should be worried, that we should be concerned? We've talked about key things such as Apple and China over the last couple of weeks. We've talked about real estate, which we'll reference here today as well. But I want to start with one of the main indicators of fear. We'll do fear, and then we'll do debt, and we're going to go through a couple of different things. So the number one thing we're going to do is we'll start with fear. And the fear index, historically, people like to use the VIX. Now, the VIX is showing a very low number. You can see we're at 13. We were a little bit lower just a few minutes ago. We're a tiny bit lower at 12.93. But the fact that the VIX is low, it's way down here in this lower level. Some would look at this and say, see, there's no fear. We're ultimately confident. VIX is low. There's no fear. We're seeing this stay way low, and that's a good sign. That's an indication that there's no concern and no hedging. That's fine. Historically speaking, though, the adage is when the VIX is low, it's time to go, meaning it's time to get out. It's time to get out of trades. When the VIX is high, it's time to buy. It means that we've reached the peak of fear. So this is a lagging indicator, and generally speaking, you'll see I don't generally track trends on the VIX. I track horizontal levels on the VIX. But when we're at these lower levels, we're looking for the VIX or the fear to bounce. We look for it to bounce. And when these bounces occur, we're looking for market corrections at the same time. So sell-offs that are accompanied by rising VIX or rising VIX fear, uncertainty, hedging that causes or triggers a sell-off. Now, I'll come back to the simple moving average here in just a minute with the 10-day simple moving average, but we're not going to use it on the VIX. So if the VIX is very low, it may be time to go. And we look back historically in the area between 8 and 12, these two lines down here at the bottom are generally the most extreme lows, and it can be a strong indication that it's time to look for buying opportunities. You can see the correlation between the VIX and the SPX. It's inverted. And if you look at this 1 to -1, like we usually do, so we get a sentiment that we have a very highly inverse correlation between volatility, or the VIX, and the S&P. You can see it stays below 0 most of the time. There's a couple times it shakes out, and when it shakes out, it's generally when the VIX is falling or low. So when fear is falling apart and sliding, or it's at these low points, that's generally when our correlation decouples for a moment. But the correlation remains 75% or 90% or 95%, 99% inversely correlated. So if the VIX is low and is selling off, that's fine. But if the VIX is going to bounce and go higher out of this key support area, generally speaking, we expect the S&P to fall. Now, what would trigger that? And I said the next thing we want to talk about is debt. Let's start with household debt. Consumers make up 65% of the market or GDP. This is the end of Q2, and this is according to the New York Fed. As we look at this housing debt, all the way over here to the right, the end of Q2, housing debt is 12.35 trillion, the highest level housing debt has been. It's also not just 12.35 trillion, it's about 25% higher than it was when the housing market reached a peak. When the housing market reached an extreme level, we saw treasury or household debt at 9.99 trillion. So we're seeing 25% higher amount of total mortgage debt than what we saw at the absolute peak around the housing crisis. Additionally, you'll notice that the non-housing debt, the housing debt that was consumer credit in 2008, when the housing market reached its peak, that was 2.69, call it $2.7 trillion in debt. notice that this stayed fairly even all the way through 2.5, 2.6, 2.6, 2.5, 2.5, 2.7, 2.8. And then we started widening out. It became larger and larger, bigger percentage of our debt. While our housing debt was increasing by 25%, our non-housing debt went from 2.7 to 4.7. So we've seen a 70% increase in non-housing debt. So consumers are leveraged. They're leveraged significantly. The debt and credit card balances we've seen have changed dramatically. If you look up here, you can see household debt rises to 17.6 trillion, led by credit card balances. So as we're looking at this, this is a massive move. $1 trillion in credit card debt. And the problem is we can't refinance our homes to pay off that credit card debt. This has just become constantly widening and increasing since the bottom of the housing market in 2012. So credit card debts got worse, consumer debts got worse outside of the housing. It's the worst point we've been. We've never had this much total debt. We've never had this much credit card debt. We've never had this much housing debt. And it is all 25% higher on our housing than at the peak of the housing crisis, and it is nearly 75% higher on the non-housing debt than it was at the peak before the housing crisis. So at this point, how do we adjust things? What do we look for? What do we expect? We can't refinance, and we're not willing to refinance at 7.5% rates if our homes are at 3%. According to federalreserve.gov, this is delinquency rates, and just a couple things to look at. All consumer loans are at 2.36. The last time we were at 2.36% credit card at 2.77. When we saw the all credit and credit cards at 2.77, 2.36, that was 11 years ago. That's the last time we had this type of increasing or this rate of defaults. So the defaults are on the rise. They've gone from lows of 1%, 1.5% to 2.7%, and defaults are rising while we're sitting on this higher debt, and people aren't going to refinance out that debt. From the St. Louis Fed, our personal saving rates are near record lows. And look where we had these type of levels before. 2.9, 2.8, 3.6, those low sub 3% percentage savings rates were the last time we had a major recession. And here we are again in the 3s and 2s. We're at 3.5 now, but we had dipped into the 2s back in 2022. Our saving rates are getting smaller again. So we don't have the money saved to be able to pay the debt. We aren't saving money. We're just increasing our total debt to a record high. And this is all occurring while the 10-year Treasury, 7 years and 10-year Treasury yields are what we base a lot of our consumer debt and household debt, mortgage debt on. Mortgages are usually based on a 7 or a 10-year Treasury yield. And as we're looking at the 10-year Treasury yield, Treasury bond prices, we hit a new multi-year low yesterday. And today we rolled back over from the bounce and closed down. And we look at the correlation between bonds and the SPX, they are generally positively correlated, but when we're selling off and we're reaching new lows, that means the 10-year Treasury are reaching new highs, which again goes back to all that debt that we have. And if we have a ton of debt and our yields are going up, it means the cost to borrow is rising. And don't forget that we still have an inverted yield curve. The inverted yield curve says there's no investment in long term, and we're only investing in short-term debt. So the amount of lending, even if we were willing to refinance at the 7 and 10-year rates, the amount of lending is going to be skewed based off of the numbers of investors willing to buy that debt. Currently, they can get a 5.5 or 5.6% rate, a 5.6% rate from 1 month, well, under 6 months. And the 10-year is only going to give them 4.25. 10-year is the lowest level, and our inverted yield curve stays in place. So until this inverted yield curve corrects, we do not have a normal, healthy lending market and lending environment. So there'll be less borrowing, less refinancing, and that debt will become more of a default situation rather than refinance and continue as things were. The only way to correct an inverted yield curve and get that back to normal lending practices is to either raise the longer term debt or lower the shorter term debt. There are zero signs that we are going to cut the short term debt. In fact, the ECB just raised rates, showing us that we are not done with this global inflationary market. And the US is probably going to follow suit with another rate hike before the end of the year, which means, again, we have to see bond prices continue to sell off and yields continue to rise, making it even more expensive. I would anticipate that we are going to see 5.5% to 6% 10-year Treasury yields, and therefore we're going to see mortgages in the 8s and 8.5% before the year's end. Now, two other things to look at really quickly. We do want to look at commercial debt in just a minute. We're talking about consumer debt. I do want to talk about commercial debt. A couple other fear indexes. This is from the CNN Fear and Greed Indexes. There's a multiple indexes that you can track here. The stock price index, you can see it's gone into fear. This is comparing 52-week highs versus 52-week lows. We've seen more 52-week lows over the last 4 weeks, pushing pressures lower. Actually, I guess we crossed negative back the very last day. So I guess we're about a week or so in the negative, showing that there's more stocks reaching 52-week lows and 52-week highs. Additionally, the stock breadth, this is the McClellan volume summation. The volume adjusted through there is showing fear. And it's interesting to me that with all this fear, put and call options, fear, we're just seeing more puts being bought than calls. We're seeing hedges and fear. Market volatility is fairly neutral because volatility is so low. But interesting to me that if you look down here, we have extreme greed on junk bonds. Now what this does, I'm going to use HYG, and you could use JNK here or individual junk bonds if you wanted to. But what this tells us is that we're not seeing a flight away from the high yield, higher risk debt. And I want you to remember that the junk bond world did phenomenally well right before the big crash in the 80s. It did well in the early 90s. And we look at the correlation. They do well right at the end as we see these highs being held up. It tells us that there's demand for these. People are buying and investing in high yield instruments. It means they're not taking risk into consideration. Their fear is not there. And you can see the correlation here. Look at the 1 to -1, just like we did on the VIX. If the fear index, VIX is high, it's time to buy situation, well, you can see we have a very high correlation. When HYG is doing well, so does the market, the SPX down here. If we look back to see some previous crashes and correlations, when we look back at, let's go all the way back to as far back as we can go, and look at the correlation right before the crash. The correlation remained high, and then we liquidated the HYG. HYG went from 107 to 61, and so we saw a huge drop there, and that's almost in lockstep with the market. So the market and HYG did the same thing. 2012, 2013, when we had a lot of default there too. You can see default increased in 2012, and we saw a drop through here. And we went from 95 down to 75. So we saw about a 20% drop in HYG in that same time period, and the correlation remained very, very high. So as we're holding up here, you can see we're holding up not at a high, we're holding up at a low. And so looking at HYG, even though we're holding up and we've held up for the entire year, that tells us that investors are still buying and propping up high yield or junk bond debt. It means that they have not taken the risk off the table. But when they do, it doesn't mean the correlation breaks. When they do break through support levels, if those correlations happen, we could see this liquidate and we could see the beginning of the next drop. And as we look at that debt and the concern about defaults, this is a report from LA Times talking about U.S. commercial real estate potentially troubled because of how leveraged it is and because commercial properties have been falling and to a tune of 31%. Add that to something like Airbnb, who saw a drop in revenues by 37%, and you will start seeing default. We've already seen default, and when I say default, meaning that the properties have been repossessed, or better said, that they've been foreclosed on. And you can see that we've seen this from Blackstone, Brookfield, and Goldman all have defaulted and relinquished offices to the banks. That's already happened. This was a report done just a couple of weeks ago. 31% drop in commercial prices, tons of risk, 626 billion at risk. And as we're looking at this, these all come due by 2025. 626 billion of office debt that has to be refinanced or sold in the next 2 years. Now, to do that, to relinquish that property, better said, to refinance this debt, they're going to have to refinance at higher rates. We've already seen that the debt that they already have is probably in the 3 to 5% rate. And nearly $1 trillion of debt from commercial loans will have to be refinanced at 6, 7, 8%. $1 trillion of credit card debt is either going to be charged off or refinanced at higher rates or held at 20, 30% rate. And this debt crisis that is now looming is happening at the same time we're seeing assets decrease in value. Even residential is decreased by about 4%, but commercial is decreased by 31%. Airbnb is decreased. So I do think there's an opportunity to short Airbnb and some stocks like that. But the last thing I'm going to mention is this is all happening at the same time we have an inverted yield curve, and that we created what is the beginning of what is called the Hindenburg Omen. The Hindenburg Omen is not nearly as reliable as traditionally as reliable as an inverted yield curve. But the things you look for with the Hindenburg Omen is seeing about 2% of the stocks reach 52-week highs, while 2% or more reach 52-week lows during the same week, which we have hit even today. 240 stocks hit new lows today. 175 hit new highs today. As we're looking at the moves through that time frame, one of the things we're going to look for as well is we're going to look for the McClellan oscillator to be negative, which it was all last week. Today it's bounced back up, but it was negative all last week. And then we look at a 10-week moving average. And if I change this to a 10-week moving average, you can see that you need all those warnings while you're still in an uptrend. And so that's what we're seeing here. We're still in an uptrend in the S&P, the SPX, S&P 500, still in an uptrend while we're seeing new stocks reach 52-week highs and new stocks reach 52-week lows, which there's more hitting 52-week lows, fitting into the Hindenburg Omen. All of those things are lined up together to tell us that we should be warned that we are seeing kind of a peak in the market. And like I said, I do think there's going to be a real opportunity to short Airbnb. If a bunch of those companies or those individuals that have short-term rental properties go into default, they're going to sell their properties, which means there's going to be less bookings through Airbnb. New York just banned Airbnbs, and that will be coming down the pipeline. And so you'll see a decrease in the total revenues collected by a company like Airbnb, and this could be the lower high setting up for the next drop. Well, that's going to do it for me today, so thanks for watching. We'll look forward to talking to you again.